Okay, this is an introduction to something called an annuity. An annuity. An annuity is an agreement that you make with an insurance company. An agreement you make with an insurance company. So that's you, right there. You and an insurance company, this is the insurance company, you essentially give them some of your money, and in the future they will give you some money back. And you may give them a lump sum payment, you may give them a series of payments over time, and in the same way they may give you a lump sum back in the future, or a series of payments over time in the future. But essentially you give them money and the insurance company will give you money back in the future. And oftentimes the money that you receive back comes in the form of regular payments, or oftentimes annual payments, hence the name annuity. So you may have seen this sort of transaction in many different places before, such as bonds, CDs. However, an annuity is not with a government or a bank. It is an agreement with an insurance company. Insurance companies issue annuities. Now, there's different types of annuities. Essentially, annuities are, let me change my color here, something different. So there's two different major types of annuities. There are fixed annuities and variable annuities. So a fixed annuity will give you a fixed percentage, a set percentage return. So it is fixed, it is set in advance. So for example, maybe you give the insurance company $100. You give them $100, and then after a certain amount of time, let's say you agree upon a 3% interest, and let's say at the end of whatever time you chose in advance, you and the insurance company agreed upon, they give you 3% on your 100, so at some time in the future you will get $103 back. So this sort of thing happens in bank accounts, this sort of thing happens with CDs, corporate bonds, government bonds, all sorts of things. This is very straightforward financial transaction, and it is backed by the faith of that, sorry, not the faith, the financial ability of that insurance company, the financial state, the solvency, whether or not that insurance company is going to go bankrupt. If they have enough money to pay, they will pay you. And just this, as a side note, to this date, there has not been an insurance company that has failed to pay on a fixed annuity. Variable annuity is a different matter, but to this date, there has never been an insurance company which has failed to pay out a fixed annuity. So, as a fixed annuity, a variable annuity is a little different. A variable annuity, in the same way you give the insurance company money, however, instead of giving you a fixed set agreed upon percentage return, you will get a return which depends, hence the word variable, it varies on the performance of a specified set of investments, and it usually consists of bonds and equity mutual funds. Equity means stocks, shares. So this, you have a variable percent return. So maybe 1 month or 1 year it's 3%, maybe another year it's 12%, maybe another year it's -5%. It depends on how something does. So for example, if you get a variable annuity and your variable annuity is linked to the performance of, for example, the S&P 500. The S&P 500, which is it is a group of stocks which are designed to measure how well the overall stock market is doing. So it tends to go up or go down with the broad general stock market. So let's say you get a variable annuity, and your variable annuity is linked to, sorry for my bad handwriting, linked to the S&P 500. If the S&P 500 goes up 10%, your annuity may go up about the same percent. You're probably going to lose a little bit with some fees and expenses, but in general it will go up and down as whatever your account is linked to. And you can link it, there's all sorts of variable annuities. You can link them to specific types of companies. You can link them to commodities, or link them to gold. You can link them to all corporate bonds, all sorts of different things. You can, all sorts of different kinds of variable annuities. And when many people hear the word annuity, there tends to be a knee-jerk reaction of, oh, oh no, stay away, those are bad, sorry, this is my skull and crossbones, I did not major in art. Stay away from them, it's very scary, they're very bad. However, that knee-jerk reaction, I'm gonna wipe this out, because it's not necessarily an accurate way to treat annuities, because a fixed annuity, in fact, is quite safe. As long as your insurance company doesn't go belly up, you're going to get your percentage. Variable interest rate, or sorry, the variable annuity is usually, when people say, oh, annuities, it's not very liquid, and it's very dangerous, and you just never know what percentage you might get, and they're going to take all, you're going to lose this in fees or expenses. In general, when people have this knee-jerk reaction to an annuity being a bad thing, they're usually referring to a variable annuity. And there are pros and cons it depends on the level of the fixed and variable annuities. It depends on your level of comfort and your level of risk. Variable annuities, you have more upside potential, but you have more downside potential as well than a fixed annuity. In fact, if you have a 401k, or a 403b, these are certain different kinds of retirement accounts usually provided by employers. If you go and you look in there, odds are most of what you have in there are going to be variable annuities. So it may be a large cap index, where large cap means really big companies, and it'll follow a bunch of really big companies. When these big companies do well, when their stock goes well, you will do well. When they don't, yours will go down, and so on. And this is, in fact, one type of variable annuity. So I hope this is helpful. In the next video, I'm going to talk about a different type, a specific type of annuity called a, let me get a different color here, called a fixed index annuity. A fixed index annuity. And this is a nice little instrument. It sort of takes away a lot of the cons associated with most annuities, and it allows you to participate with a lot of I shouldn't say a lot, with the upside of certain indexes, and it will provide you a floor from which your investment cannot go below. So for example, if you put $100 in, your $100 is guaranteed. You may not make much, you may only make 3 or 5% or whatever it is, but you are guaranteed a floor. And I'll go into more details in the video on fixed index annuities.